Welcome back, class. We're going to talk for a few minutes in segment 3 about the creation of money. And the authors, as they outlined it in the text, they go through some definitions for you. And one is required reserves. The quantity of reserves banks are required to hold. And then the required reserve ratio, the ratio of reserves to checkable deposits a bank must maintain. So the required reserve ratio and the required reserves are tied together and driven by the level of checkable deposits. Excess reserves are the reserves in excess of the required reserve level. So the banks have, let's just say, $1 million. So the banks have $1 million. There's some reserve ratio, and let's just say 10%, that they have to that they are required to hold as reserves. So if they hold 10% of $1 million, that's going to be what? $100,000. Excess reserves, if they were to hold $150,000 in reserves, they'd have $50,000 in excess reserves. And all of these definitions, or all of these factors, let's call them, drive the creation of money in circulation. So you can see as checkable deposits increase, decrease, as a reserve ratio increases, decreases, what are their excess reserves, all of these, it's very fluid and very flexible at any one point in time. And then the authors talk about the deposit multiplier. And the deposit multiplier is the ratio of the maximum possible change in checkable deposits to the change in reserves. And it relates to the potential increase in the supply of money. Potentially, how much checkable deposits will grow for each dollar of new reserves in the banking system. So that multiplier, again, is going to be tied back to the definitions they provide you for required reserves, required reserve ratio, and excess reserves. And then they do put out one other definition kind of as we move forward, and they talk about banks being loaned up. And that's when the bank's excess reserves equal zero. So if a bank is loaned up, they don't have any more reserves that they can loan out to borrowers. And then if you're looking at M, they talk about it in the equations. They've got M with a little subscript B. It's the change in deposits over the change in reserves. And so if it's 10,000, your change in deposits and your change in reserves is 1,000. 10,000 divided by 1,000 gets you to 10, and that is M with a little subscript D. And if the banks are loaned up, then the reserves are going to equal the required reserve ratio. In the text, it's a little r's, the required reserve ratio times the deposits. If the banks are loaned up, then the change in reserves equals the required reserve ratio. That's a mouthful to say. Required reserve ratio times the change in deposits. Change in reserves, again, equals the required reserve ratio times the change in deposits. So the change in the reserves that the banks have to hold, it's going to be that required reserve ratio multiplied by the change in deposits. So changes in deposits up and down multiplied by the required reserve ratio is going to get you a change in the total reserves that the banks have to hold. And if you want to find the multiplier, it's basically the change in deposit divided by the change in reserve. So in the text where they're talking about the multiplier, they use the notation little m, little d with the subscript d, and that to calculate that multiplier, it's the change in demand divided by the change in reserve. And if you do a little math magic, it's actually you can find the multiplier, and you can play around with it, it's, 1 over little r equal change in demand divided by change in reserve, and that gets you to your multiplier. And if you look at it from that perspective, if you increase the required reserve ratio, you're going to decrease the multiplier. If you decrease the required reserve ratio, it's going to increase the multiplier. So again, we're looking at ratios. And 1 over the required reserve ratio equals the multiplier. So remember, if you increase that, so it's going to, if you increase the reserve required ratio, again, it's really a mouthful to spit out, but if you increase that required reserve ratio, what's going to happen? Your denominator is going to get bigger, right? Your fraction is going to get smaller, and the multiplier is going to get smaller because the multiplier is equal to 1 over that required reserve ratio. So again, go back to your algebra, the numerator staying constant. And so what happens with the denominator is the denominator gets bigger, required reserve ratio gets bigger, the multiplier is going to get smaller, and vice versa. If required reserve ratio gets smaller, the multiplier is going to get bigger. Again, we're looking at ratios, you're looking at fractions. Just think about numerator stays the same. What happens when that denominator changes? In the real world, understates the deposit multiplier. Banks decide to hold on to excess reserves. Not all funds are passed from bank to bank, and the Fed plus banking system drives the money supply. So some people, they cash rather than deposit a check. So you write a check and you give it to the dude doing your lawn service, or the dude doing the pool service, or the woman but the individual that comes in and cleans your house for you. You give them a check, they may not go to the bank and cash it, so it may not go from one bank to the next. They may go to the bank and cash it, and it comes right out. Deposit and money contraction. With withdrawals decreasing, the money supply by the multiplier that you withdraw. So everything depends on withdrawals and how much you have in that, checkable deposit account and what that required reserve ratio is. If the banks are loaned up, you can play a little, math magic. And if 1 over the required reserve ratio equals change in deposit over change in reserve, then if you cross multiply, you automatically know that cross multiply, rearrange a few terms, you automatically find that the change in deposits equals the change in reserve divided by the required reserve ratio. Again, mathematical gymnastics, math magic, however you want to look at it. But at the end of the day, just think about, you're talking about fractions, or if you are, go back to your algebra classes where you're and think about the way you approached your math in your algebra classes. Do some math magic, do a little cross multiplying, do a little, shifting of terms. And at the end of the day, you're going to end up with the right answer. And then the authors kind of start to move into the regulation of banks, because we're going to get into the Federal Reserve in a few minutes. And among the most heavily regulated of any financial institution. And it's heavily regulated. And even though, and because of corrupt business practices, crises of confidence, think about the failed banks that put in this past late summer, maybe early fall, maybe earlier in the summer. you had banks starting to fail, and people were getting a little jittery, and so there is a confidence crisis sometimes in banks. Short-term volatile deposits to make long-term stable loans. So remember, you're depositing money either in a checking account, a savings account, and you have, as the owner of those checkable deposits or the savings account, you have access to that immediately. And so where banks run into trouble is they take your money that you've deposited, especially in a savings account, and they start to loan it out to borrowers. As they loan it out to borrowers, the borrowers have a much longer time horizon to pay that back than you theoretically have when you deposit that money into the bank. So that's where the concern is: short-term volatile deposits, and then the banks take those and turn around and make long-term loans to borrowers. Small fraction of total deposit liabilities are in cash. Poorly managed banks impact well-managed banks. And that's true, because a few poorly managed banks, and again, go back to when they had that run, there were a couple of West Coast banks. I want to say Republic Bank, and there was one that was in Silicon Valley. And it almost started a bank panic. It didn't really get to those proportions because the government stepped in. But between the Treasury, the FDIC, which is the Federal Deposit Insurance Company, and the Fed, those three organizations try to regulate and try to decrease the rise in potential panic and to stabilize money supply. The combination of those three stepped in when we're having the issues in 2023 with banks and stabilized the economy, stabilized the confidence in the banking industry. Otherwise, you're going to have a run on the bank, a run on multiple banks. And you're having runs on banks. That's what happened in the great, in the late 20s, early 30s, when you had the run, the quote Great Depression. And then the authors talk about deposit insurance, and the FDIC, or the Federal Deposit of Insurance, it's Federal Deposit Insurance Corporation. They, banks pay a premium for every $100 of bank deposits. And you as a customer, as a single customer, I think it's insured up to $250,000 for each account ownership category. My wife and I, if we had enough money in the bank deposits, we'd be insured, because there are two of us, we'd be insured up to $500,000. Incentivizes the bank's managers to take on lucrative high-risk ventures. And to some extent, that's been the concern with the FDIC, is that it incentivizes banks to get a little risky with your money, because they know that if they go belly up or they make some bad loans and the bank goes out of business, the FDIC is going to swoop in and take care of the depositors. And it's what you get into the term moral hazard. And I can't remember whether we've talked about it in this class or not, but moral hazard is a tendency to take on extra risk after insuring against it. Again, you see it in banks. You see it in property casualty insurance. Good example, you've got insurance on your car. You decide that after a couple of years, you don't like your car. You don't want to keep it anymore, and you start leaving it unlocked. You start maybe leaving the keys in it, because you know that if somebody steals it, the insurance company is going to come in and reimburse you. Let's say you rent an apartment, and you have renter's insurance for your television and your iPad and your cell phone and any other valuables that you have, and you start leaving the front door unlocked, or you start leaving the keys in the lock, because at the end of the day, you know that the insurance company, to some extent, is going to come in and bail you out. So that's the concept of moral hazard. You see it in healthcare. Somebody has a health plan, and moral hazard is, the insurance company is going to take care of it. So if I get sick, or if I don't manage my health status, or if I don't take care of myself, the insurance company's going to come in and take care of it anyway. So, I can drink and I can smoke and I can take drugs. And if I have health issues, who cares? I paid my premium and the health plan's going to take care of it. So that's an issue with moral hazard. And moral hazard is an issue with just about every type of insurance that you have. If you either own a home, or once you get out of college and you decide to buy a home, you're going to have homeowners insurance. And a really moral hazard there, because if you don't have smoke detectors, if you don't have a security system, you don't keep your doors locked, negative occurrences, could happen. And, the insurance company's going to take care of it. Insurance company's not going to do that great a job of taking care of it. They're going to take care of it to some extent. And that's where you end up with the issue of moral hazard. And the fractional banking system and the generation of risk. Consumers may not scrutinize banking activities as much as they should, because their perception is, I've got $250,000 that's going to cover my deposit. Who cares if the bank is loose with my money, or who cares if they take excessive risk? FDIC is going to come in and bail me out. And they regulate to prevent bank failure. Banks are required to maintain a minimum level of net worth as a fraction of assets. And so that's across the banking industry. The FDIC audits and can close banks, or especially closes insolvent banks. So they're either closing banks, or if banks are moving toward insolvency, they will try to step in and either close the bank, or they'll try to find a buyer for the bank and its assets and its net worth. And again, the FDIC can arrange a sale of a failed bank, and that happened with a couple of banks that went through the issues back in late spring, early summer. Banks are regulated in response to financial crisis, deposit insurance, and bank regulation driven by, again, the Great Depression. And for those of you that probably don't really remember the dates from your history class or maybe your finance class, here's 1929 to 1933. And what they're trying to do with regulation of the bank is they're trying to minimize bank failure with government intervention. They're trying to maximize the net benefit to society by ensuring that the banks don't fail. And remember, from your micro classes, when you maximize the net benefit to society, it's a societal's marginal benefit is set equal to the society's marginal cost. And at that point, the net benefit to society is maximized. A third of the banks failed in the Great Depression. Life savings were lost. You can imagine what it did to the money supply. It's the largest economic calamity in U.S. history. The Glass-Steagall Act generated the creation of the FDIC and separated commercial banks from riskier institutions. 1999 law reversed the separation, and you had the big, I guess it was in 1980s, the big collapse of the savings and loan banks. That was a mess in the early 80s. Savings and loans, they loaned out, they were back to riskier deposits, loaning out dollars, and the collateral that secured those loans, the value of that collateral failed. Financial crisis of 2008 and the Great Recession, you may, to some extent, remember that one. It hadn't been that long ago, 15 years ago, essentially. And that was, generated a huge disaster in the housing market. The Dodd-Frank Act of 2010 regulates all financial institutions, and it actually increased the scope of the Federal Reserve. The Volcker Rule controls types of investments that banks can make using investor deposits. So Volcker was one of the chairmen of the Federal Reserve, and they implemented the Volcker Rule to help try to manage the types of investments, or the types of investments that bankers or banks can make with your money. And since we're talking about the Federal Reserve, I think that's probably a pretty good place to kind of take a pause. And we'll come back and talk about it. I think we're going to talk about the Federal Reserve. We're going to talk about a couple of other types of concepts. And then I think this last segment will kind of wrap up Chapter 10 for us. See everybody in a few minutes.